taking past commodity prices, correlating that to past revenue, and then taking what is currently being traded right now on future markets, what actual price is trading for in the future of finished steel commodity, and correlating that back with that past number for revenue going forward. So I obviously responded to that on D2L. Someone followed up with a great question, just saying, hey, I see the decreasing revenue. I get that, but help me walk through the difference between margins decreasing at a faster rate than revenue before bouncing back up. And the answer I provided there, I'd like to go just a little more in depth on that. I went with a more conservative cost of sales, which is really driving that difference in changes between revenue and my operating margin. Specifically, I went with a 5-year average to try to get the most conservative base possible. So it is a very conservative, highly priced cost of sales. And with that, I'll turn it over for questions.
Questions from the audience. We typically prefer that the crowd here ask a question or two about, the company. It could be anything from ESG to how their models work, to their drivers, to how the company operates. So, you're the first man on the block. Of course, Dr. Krause and I remain in reserve. Yes.
Yeah, I just have a couple questions on I know we talked a lot on D2L about the currency.
Yes.
How do you add that into your model? And did you account for anything if it stays flat or if the US dollar gets weaker?
Yeah, certainly. So I think you're kind of referencing a driver. I mentioned that I put in 200 basis points premium was added to my WAC for Latin American and South America country risk, which also includes currency risk inside of that from Damodaran from NYU.
And so with currencies, there's a couple different approaches you can take, right? To add some color.
Absolutely.
One method, if they're primary one country specific, you can go to that country and you can often go to the Chicago Mercantile Exchange and they'll have 5-year futures. And you can go out and see what those look like. I guess there's 3 methods. And you can model your cash flows into the model each year and change them based on what you're seeing there. Another approach would be you have some great economists. It's a little harder to defend, but you're leaning on their work with a similar approach. And then the third is, well, I've got an amalgamation of Latin America. I'm not sure I trust just modeling reals, for instance,
right,
which I think we're addressing here, right?
Yeah, absolutely.
Well, you can slap what's called a risk premium on. And lucky for us, it's not always updated, so that's a fair critique. Damodaran out at NYU Stern sometimes will update a model and give you an idea what his thoughts are for an adjustment for currencies, and I think that's what you're relying on in this case, right?
Correct, yes.
Yep. Sorry, just wanted to give folks a flavor if they start modeling, because this is a common question that comes up.
So this will be a little odd, but for most students, they're sitting here saying this is a Latin American steel company, right?
Correct.
Headquartered in Luxembourg.
Yes.
With a very unusual insider. What is your insider ownership?
That is wrong on the chart. I probably should have updated that. It's 62%.
Okay.
It's divested from its IPO in 2006. From its
Take us through that history, because again, a Mexican steel
Yeah,
company owned by a
absolutely.
Luxembourg
So-
company, 62%.
So
ownership.
Ternium's actually, when it was founded and launched its IPO in 2006, it was the combination of 3 steel makers. I do not have each of those names, nor can I pronounce them off the top of my head. It derives from, it comes from the San Faustin group, which then goes down to the Technic group, and then they spun this off into Ternium with its IPO in 2006. So there is still a connection back with holdings, but it's not, management doesn't think it's a concern. I also don't think it's too much of a concern.
So I'll just set up your comparables. Like, did you weight them? How'd you pick them?
Peer cups?
Yeah,
Absolutely.
How do you think about that?
So I kind of looked for, and there's similar questions at D2L, kind of looked for similar models or business models, kind of the direction that the company wants to go in, as well as just overall market cap size and comparable numbers, comparable business models. There was a question about the weighting. I can run a sensitivity analysis on weighting up some of those larger peers if necessary, but I do believe that they're fair and accurate peers.
Yes, ma'am.
It's great to see your ROI is greater than your cost of capital, but if you could Can you walk me through how you got 35.60 for your ROIC? Just looking at like historically,
Yeah.
it seems like if they haven't really surpassed 10, so
Yeah, that's the last 12 months.
So one thing that helps, and this will be good for everybody, now that we're back in person but broadcasting, it helps if you can repeat a shortened version of the question because often you can't hear it if you're offline. No, you're doing a great job. I appreciate someone's got to go first, and that's rough. So forgive the extra commentary for you, but
Perfect.
you could kind of respond. That lets her know you heard her question right also, and then kind of answer it. That'd be awesome.
Yeah, so your question was about ROIC, pretty high compared to historicals. 2021, they've released 3 fiscal quarters already, and we're still waiting on the 4th quarter. That gets released on the 15th of February. So it's listed as an estimate for the year because I did have to forecast 2021. Obviously, 2021 is like their best year ever. Steel prices were at an all-time high, and so they definitely capitalized on that, and that's why, given the past 12 or the trailing 12 months, that ROIC is where it's at.
Yeah, great job here. I really like this company. This is a 2-part question. You answered half of it already. I was going to ask when your earnings come out. Also, what other target dates do you have where we should reassess this holding? And then when earnings come out, we've seen a lot of companies that have jumped around a lot in these past couple days with earnings. Do you see that happening potentially, and should we enter more or exit if that does happen?
Yes, certainly. So question was more about target dates, earnings, kind of surrounding expectations there. I don't have any other target dates beyond this release of the earnings. I guess I can circle back to you on that if necessary. I would say I think they're going to reach expectations. I don't think there's going to be a lot of volatility based off of where they're going to come in. I think they're going to report pretty good earnings because they've been able to capitalize on those steel prices.
Okay.
Just trying to get a better understanding on the industry you're operating in. So when you say about 72% of your revenue come from emerging economies, do you have examples of those countries? And
Yeah, absolutely. It's more like Latin America. Technically, if you're going off a GeoRev fact set, Mexico is classified as an emerging economy.
okay, so then
That's 53% of their revenue, to clarify.
so then your argument is saying that they're losing share basically in the Mexican market. If the market is expanding so much and they're in an emerging economy building infrastructure, I'm just kind of confused on how. I know you backed into your revenue, but the industrial space, like, I'm confused on how the industry overall, your company plays into it.
Yeah, absolutely.
If you're saying EM is a driver, but then you're losing share based on your economy. Just any color on your competitors and industry would be helpful.
Okay, so that was a long question, kind of talking about competitors, market share, etc. Specifically regarding Mexico, they're the leader in Mexico for steel production, so they're obviously going to continue to be able to capitalize on that. Some of the other acquisitions have been in Colombia, Brazil, etc., which allows them to, again, continue to expand that base of those emerging markets in Latin America, furthering kind of that hedge against their dependency with Mexico, which I wouldn't even call it a dependency, but their large share of revenue from Mexico. Does that answer your question, or do you want more color?
No, it does. That's fine.
She didn't like the answer, but it answered it. At least.
I'm looking at your forward PEs. Did you do any sort of forward PE analysis of your comps as well? Because you have it dropping down to 2 and then building back up. So we usually want to see it the other way around. So I'm curious if you looked at your peers, figure out, and have any sort of color on what a relative that would look like in 2022.
Yeah, absolutely. I think based off of the peers, a lot of them have a similar business model, business structure. I did not do forward PEs for them, but I will say that assuming what I've done in my research, their revenues, like Ternium, are very correlated to those commodity prices. So I would assume that if what we're going through would be the same thing for them as well. And I can circle back if you want those forward
Yeah,
PEs.
I guess good. Thanks.
Professor Walker.
I'm sure this is not the first time that the steel company has declining prices. Have you looked into the past history to find a period of time when they have had
Yeah.
declining prices year over year? What kind of negative operating leverage is generated by that low prices?
Yeah, absolutely. I think you can look no further from 2018 to 2019 and then 2019 to 2020. Obviously, steel prices kind of took a hit. I would say their operating leverage stayed relatively constant. It decreased a little bit over that time.
Can you give me some how the numbers looked?
Yeah, absolutely. So let's go with, you want operating margin?
Yeah.
So,
Profit operating margin is fine.
okay, so for 2018, sorry. Second.
We can take this offline.
Yeah,
Yeah,
I'm
absolutely.
gonna look it up. Big macro picture. Mexico, basically 60% of their revenues. What's the GDP forecast for Mexico over the short and intermediate term?
That's a good question. I would have to get back to you on that.
Yeah, I mean, that's real important, right? Because this is a material / industrial type company, very much.
I believe that outlook was good, but I don't have the exact number.
Okay, without the exact number, how do you feel about the Mexican economy, the political situation? Are you comfortable owning, even though it's technically based in Luxembourg,
Right.
operations are Mexican?
I feel pretty confident about it. Obviously, there's some political instability there from time to time. Mexico is, has been a little bit of a fluctuating country. I'd say, though, I'm pretty confident in the long-term outlook for them, specifically with kind of the direction they're going with infrastructure plans, etc. I think they will be poised and primed to capitalize on that.
All right, well, thank you very much. Appreciate it. It's always tough to go first out of the gate. Appreciate you being here. So our second victim / volunteer will be August. August has some kind of, online news-ish market, something. It's all out there in the ether.
Yeah.
But if you say being August, if you could kind of walk us through how you came upon this company. It's something that everyone keeps asking, you feel you might want to answer, or something that got left, that'd be great, then we'll switch over. Thanks, take it away.
Yeah, thank you guys for being here. If I haven't met you yet, my name is August Peterson, and I cover domestic financials. I found MarketWise in an investor letter from a hedge fund that I've been following, and I thought they had a pretty compelling story considering that they've grown. They've been operating since 1999, and they've grown from $35,000 invested capital to over $500 million in annual revenue. And they have really good unit economics, and it's highly scalable. So that's kind of what attracted me to this company. I think something I want to address right away is my ROE and ROIC calculations. And I just kind of want to preface this by saying that I don't think these metrics should be weighted as highly when you're looking at a company of these characteristics as when you're looking at another company that's being pitched today. And what I mean is, as a subscription-based company, obviously your liabilities are going to be greater than your assets because your deferred revenue account is so large. So if you were to do a book value approach to ROE and ROIC, you'd be getting a negative value. But here, in my box, I have a positive value because I use a market equity approach. So basically, I just took NOPAT, now divided by the market value of the shares outstanding. So that's why I have positive numbers here. And with this calculation, my ROIC crosses my WACC in 2026. But if I were to use a book value approach, my ROIC would be negative 40%, and my ROE would be negative 13.3%. So with that, I think I'll open up for questions.
And the mumbo jumbo on that is in accounting, right? When you make a software sale or a license sale, you can only recognize it as you earn it. So oftentimes, a good way to model that is, say you sold $100, you're recognizing $25 next year and each of the 3 years after. Well, if a company's constantly growing, they're only recognizing 25% of those sales, which means they've got to service it all. They spend cash, but it's tough to catch up.
Yeah.
Yep. Correct.
Did you do any Google Trend analysis for some of the subsidiary, research companies? Because I'm just worried that, obviously the market's been fantastic going into this year, and we've seen a pretty significant decline. And part of the thesis is, more people investing and stuff like that. I'm just concerned over if, now the market's pulled back a little bit, have they lost any market share or losing,
Yeah, his question is about Google Trends, on if the brands that MarketWise owns has lost any of its reputation after COVID-19. And that's a fair question. I haven't done a Google Trends analysis, and I can get back to you with that. But I will say that paid subscribers are still growing at 3% by the end of this fiscal year. Free subscribers are up 40, I don't know the exact number, but it's in the 40%. Revenue is still rising, so we're not in a decline. They're not losing market share. We're still in a period of rapid growth, in my opinion. So
Thanks for asking. I'm going to throw a quick plug in for your class. You're going to be doing some data analytics, learning how to do Google Trends analysis, very important part of what analysts should be doing now. And it would, you'll find it would have been a very interesting analysis for these various services. So we'll get there, right?
Questions from the audience? Yes, sir.
You mentioned acquisitions being a really important part of the strategy, so I was just wondering if there's any acquisition targets that you identify in the future. And I was also wondering how these acquisitions are going to be financed, and if you think that the rising valuations in like the private markets is like a concern for them to be able to find good deals on future acquisitions.
yeah, so I'm asked about M&A activity and acquiring new companies because obviously MarketWise is highly acquisitive, and I don't know, they have a highly accretive track record of M&A activity, and that's kind of my second driver. In the last earnings call, management hasn't disclosed exactly what targets they're looking at. They did say that they have a dramatic increase in the number of inbound inquiries since their SPAC merger. And I guess this is sort of in my driver as well, but a lot of the capital is going to come from, obviously being a public company now, and they just entered into a revolver of $150 million in quarter three. So they have a lot of excess capital. Also, that coupled with the excess cash on the balance sheet, cash makes up about 35% of their total assets. So they're in a good place to acquire companies in 2022. About your second half of your question, I think was about the valuation of public companies. I haven't looked into that too much, to be honest with you. Management hasn't really addressed that. But I don't know, in my opinion, they have a pretty good track record of building companies from scratch. And that was kind of more of my PowerPoint. I didn't touch on it in my write-up, but I do have faith in them for building a company in annual billings per year. So it's kind of that's my answer. Thanks.
All right, well, then you.
So you, in your first driver, you talked about how majority of their customers are baby boomers with 51%, but the company also recognizes their opportunity with like the millennial generation. So how are they actively like pursuing this generation?
Yeah, that's a fair question. And I got a few of those on D2L that I feel like I should have addressed. But
What was the question?
oh, sorry. Her question was about baby boomers and how they're the majority of our customer base and how we're planning to grow millennials and other demographics. And that's a great question. Management's talked about how they're not like a boomer company or a millennial company. They kind of stress that they're just in the business of attracting investors. That being said, over time they are recruiting a ton of younger editors and writers, and they kind of say that they're focused on hiring people who are thinking into the future, and they're not necessarily focused on demographics, but more so like new asset classes. Dale Lynch, the CFO, also talked about how crypto-based campaigns are the most successful in the past year. So their focus isn't really specifically on millennials per se, but they are focused on new asset classes and other investments that require more education. They also mentioned that the very end of their customer distribution has grown at over 400% in the last year, which is pretty significant. And their M&A strategy is targeting, obviously, these new asset-based companies that are more privy on that.
Nice job, August. You mentioned as of Q3 2021, the conversion rate of free to paid subs was 5%. You also mentioned there's over 12.8 million free subscribers as of right now. Does management have any strategies to increase the number of free subscribers coming over to paid?
Yeah, so Aiden's question is about conversion rates, specifically the free to paid. And I think when you kind of look at free to paid conversion, paid to high value and high value to ultra high value, it looks like free to paid is not doing that well at 5%. Just as more background, paid to high value is like 34% and high value to ultra high value is like 38%. So at 5% it looks pretty low, but the average conversion rate from 2018 to 2020 was about 2%. And I know in 2020 it was about 6%, and that was kind of catalyzed by COVID-19. So at 5%, it looks pretty good right now. But as far as what they're doing to increase this in the future, management also kind of talked about how this is driven by engagement. They're not necessarily focused on converting free to pay necessarily, but they're more focused on keeping customers engaged on their platform. And they said that the new products that they're releasing that are more technologically focused add a lot of stickiness to their consumer base. And I also believe this kind of ties into my third driver a little bit, but the sponsor that took them public, Ascendant, they have a lot of experience in the attention economy, and I think with their years of experience in predictive analytics and data science, that they're going to be able to drive retention and conversion rates because of that.
First question is just kind of a quick yes or no, but did you add any sort of liquidity risk premium onto your WAC?
So Elise asked about liquidity risk premium. I didn't add that to my WAC. I did add a 75 basis point premium to my 21 through 26 WAC, just because of brand reputation, because there are companies out there like FactSet and Reuters that have been public for a while, and they have a strong institutional reputation. So I put MarketWise, sort of just because they're in their infancy being public, to have 75 basis point WAC, but I don't have a liquidity risk premium.
We're entering the speed round. Bizzle.
No, Aiden, I should ask the question.
All right, this is.
So you mentioned conversions. Do you have a subscriber turnover rate by chance? And if so, how would that affect revenues exactly?
Yeah, so Nasser asked about subscriber turnover, and I guess if I could clarify, are you referring to like a churn rate, sort of?
Yeah.
Okay.
So like they subscribe, and then over time, if they're not satisfied, then they sort of reveal.
Yeah, so that's a great question, and I didn't reveal this in my write-up or my pitch. I probably should have, but their churn rate right now is about 1.8% a month, and annualized, that's about 80%. And that doesn't, obviously, like companies like Netflix and what have you are way higher. But I will say that though it is 80%, their average revenue per user after that first year of churn is only like $65. And their average revenue per user right now is about $770. So there's kind of a lot of churn, but the customers aren't that expensive. They don't pay a lot. So
that's Robert.
Robinhood had really poor numbers reported just recently. Is there an hangover effect that this company would have be comparable to Robinhood, given that they probably have some overlapping clients or demographics?
Yeah, so Mr. Walker asked about tying to Robinhood, the amount of brokerage accounts that are being opened. And that is part of one of my drivers. I will say that my customer base right now, about 51% is baby boomers. So I don't think that's going to be I don't think that's going to tie into my model in a big way, just because a lot of people retiring, I'm rephrasing this wrong, but think about like Charles Schwab, like the average number of investable assets, the average amount of money per account is about $420,000, which is a lot higher, and obviously people go to those more established brands. So I think the demographics that I'm serving have a lot more investable assets, and I don't think, in short, that Robinhood's shortage is going to affect this model too much.
What are the important
Last question is a 30-second one over there. Yep. Sorry, we're already over time. Yep. You got a question? No? Okay, we're good. You want your fourth quarter? When does it report?
They have not reported for fourth quarter yet.
All right. Thank you. Thanks, August. Now your encouragement from your cheerleading section back there. We're ready to roll. Same deal. Talk us through how you came upon this company, because I know it was your very first choice. Right from the beginning, you stayed with it, and I appreciate the perseverance in that regard. But take us away.
Absolutely. Hi, everyone. I'm Margaret Diedrich. I'm a junior in the Applied Investment Program, and I cover energy. So today I'll be pitching Renewable Energy Group. So the idea here basically is oil is projected to peak demand in the next 10 to 15 years. We wait for a cost-effective renewable energy to come into play. And so this company specializes in making biodiesel. This is an energy source that works today and lowers carbon emissions. And this company specifically had a tough beginning of 2021. They had to go through a restatement of financials for the years ended 2018, 2019, and 2020. Overall, it was 1% of revenue, and it was because of BTC, which is a tax credit. They were the improper claimant. It wasn't material for 2018 or 2020, but it was for 2019. After that, there was a hurricane that shut down production of their company for one of their facilities for 2 weeks. So all this combined kind of made it had the stock price drop significantly. So this is also kind of a timing play here. Something I'd like to address right away in my write-up, there is an error. So the price target I'm pitching is $53.12 with a 37% upside. And I will just address right off the top some detailed questions about the government incentive revenue segment. So in my model, I split it up between biodiesel sales and government incentives. And I looked at it from a historical standpoint. So for the past 4 years under the Trump administration, these incentives have grown at a CAGR of 12%. In my model, I tried to be as conservative as I could going forward, and I used CAGR of 3%. So that is, I thought, very conservative, and also took into account the risk of possible decreases in incentives going forward or a slowdown of them. And yeah, I'll open it up to questions.
Questions?
Talk about the biomass itself. I mean, the process. I mean, this is similar to a distilling or a refining process. Help us understand what's being converted here.
Absolutely. So this company takes feedstock. They use 6 different types of feedstocks, and they convert this into renewable energy. So basically, the energy just comes from the sun, as compared to like a gas or petroleum diesel. Then they take that and they make a couple different products. They have their most popular is B20. This is a mix between their product and diesel. So that's what they use. It can be used in any sort of diesel engine.
So who's the end customer that's buying this B20 from them?
Absolutely. It goes to different distributors. So there's different municipalities buy this. It goes to, they do direct to customer, fleets of trucks. It goes into airplanes, different transportation fuels.
Your third driver is ESG trends, but you have a ESG rating of a B.
Yeah, I'd like to. Exactly. I'd like to address that too up top.
What was this question?
Oh, sorry. So ESG trend or ESG rating is a B on my top box, and this is a renewable energy company. So what's difficult in this space is, so this company does these mixes between diesel. So it's not completely green, but it does reduce carbon emissions by 80%. So this comes from the sources Refinitiv. MSCI rates them as an A. I was just trying to be as straightforward that there's these different kinds of ratings out there. So it's basically how you look at it. I look at this company that this would reduce carbon emissions going forward. But great question. Thank you.
Right. Nice job with your account table. I like how they're all roughly the same market cap. But I was just curious. Last semester, I think we bought another biodiesel company called Darwin. It's a little bit bigger, so I was just wondering if it's not in your account table, if you could just talk about it a little bit. Like, what's the difference?
Absolutely. Thank you for asking that. So when going through my peer selection process, I tried to look for things that were similar revenue and market caps. And so with this product, there's multiple products that can be used the same way. So I looked for 2 petroleum companies and then also 2 renewable companies. And the way I weighted them is I tried to be conservative with the ones that were more closely numbers that aligned with mine. So I did a 35, 35, 50, 15. So that was the idea there. Thank you.
Great job here. I have a question regarding your third risk. So you have 15-20% of their revenue coming from government projects.
Yes.
Did you look at what would happen if these projects were to go away, what the valuation would look like, and how likely is that scenario?
Absolutely. So, kind of like I mentioned in the beginning, it's historically since this company's inception, they've always had this segment of revenue that comes from these government incentives. And I can get into the weeds a little bit about this. There's things called a Renewable Identification Number, and it's this program with the EPA where there's these different renewable volume requirements, and it basically, this RIN can be traded as like a commodity for these different companies that need to have these obligations. So going forward, the EPA just came out with the highest RVO ever, and there's some talks that Biden might be declining the RVO going forward. But, so there's a little difference in the news right now with the EPA. But I also addressed it and put a 0.75% risk premium on my WAC to try to put that account for that risk.
Okay, did you, in your valuation though, did you take that revenue out and see what the DCF would look like?
I did not. So if it came out, the company wouldn't be profitable. Right now it's about 15% of revenue.
Thank you.
Hi, can you talk a little bit about how they're securing feedstocks? One of the biggest issues in the renewable diesel industry isn't the demand, but the supply. So are they, looking for acquisitions in that space? Do they have long-term contracts? Just how would that appease any risk that would come from supply issues?
Absolutely. So the company, they have about six different sources of feedstock that they can use, and so they utilize the spread to mitigate risk if one feedstock increases exponentially. And right now, feedstocks are at the all-time high. So and right now they're profitable. They were up, operating margins up from last quarter of last year. I can touch base with you with some acquisitions and things like that later.
And then a second question was about regulatory incentives. So that's kind of crucial to this space. When I was looking into Darling, there was some bullish trends with the Build Back Better plan, but a lot of that has flopped. So can you just talk about maybe other regulatory incentives that are going to incentivize companies to be using this as opposed to just regular diesel as a habit?
Absolutely. So the EP series, so these renewable energy identification numbers are they're in compliance with this EPA mandate, and so going forward with that, it grew 12% under Trump, and he also had these waivers for these refineries could sign, could just waive their requirement. EPA put a total stop to that in this year. So I think going forward, the time horizon of a portfolio, it looks good for the next 5 years. But I can come back to you with some more certain initiatives.
Right. To piggyback a little bit tangentially off of Lisa, you might have a sense of where I'm going to go. This is a complicated one. Margaret and I learned that there's the equivalent of a crack spread in this industry. And for those that are unfamiliar, it's kind of how do you measure the profitability from what you have to do to convert it from corn and other fuels into usable fuel. And that spread is negative in this industry. So as a result, they hedge across 6 different products to try to counter, but all 6 are currently negative, right? So they only exist due to government subsidies. Could you give me a little color on what you learned and how this will affect the upcoming year? Because, right, we both freaked out a little bit. Every single product they sell is negative without. Can you give me some idea on how that looks to you going forward, what you learned?
Absolutely. So right now, with all of them, the hope is that the spread and these different feedstocks would hedge against something like this happening. But this last quarter, they were still profitable. And also, so they enter into these hedges. What else did I learn about that? I can also follow up a little with you after.
No worries. All right, last question. Cross, you got one, or we want to?
Well, would you replace Darling in the portfolio? I mean, are these so similar that?
I looked into Darling. I don't think that they're, and Elise and I could have another chat about this. I think it's a good idea to have both in the portfolio. That's just my opinion.
Quite frankly, would be our only energy holding if it gets in, right?
Yes.
The aim fund one's cold, no fossil fuel company, just so you know that, all right? So this is an energy company that,
All right.
to be added.
Well, thank you, Margaret. We
Thank you
really
so much.
appreciate it. Next up, we got Kendra with Prestige Consumer Healthcare. Like I said, next time Kendra hit me up a little bit earlier, I'm happy to work with you. Absolutely. Looking forward to hearing how you pick this company, and then if something everyone keeps asking you doesn't seem to be making sense, or if there's one thing out there that maybe didn't get a chance to get addressed. Take us away.
Absolutely. So my name is Kendra Preissner, and then for my screening, how I chose Prestige Consumer Healthcare, I actually was doing the screening on FactSet, and some metrics that I was looking for were a good EV to EBITDA, which is ideally I wanted it below 10, PE below 20, ROIC I wanted it to be greater than about 10%, and then net debt to EBITDA less than 3, and then float below 10%. And then after putting in some of those metrics and finding no companies that were within the right market cap range, I just massaged some of the numbers, and then I actually came upon probably like 3 other companies I was looking into before settling on Prestige, and this happened to be one of the competitors that I originally did a relative eval for against one of the companies that I thought I would be pitching earlier. And then about Prestige, they just participate in consumer healthcare products. 90% of their revenue is domestic, 10% is international. And then just going into some of the major questions that were concerning the biggest thing, which was my DCF. I did notice it was a huge upside, and that was why I weighted a little bit lower. And some of the things that probably contributed to the huge upside in the DCF was the way that I weighted all of the growth from the revenue segments. I broke it down by the domestic scope and then the international scope, which was 90 to 10, and I did some projections then going forward based on the way the products kind of were segmented. So there was like women's health, dermatologics, and other segments. And then I did forward growth for those and then weighted accordingly 90 to 10 for projected growth. And then that just happened to be larger growth scales than what the depreciation and deferred taxes and things were. So I believe that's what pushed the evaluation up so high with the listed 183% or $183 intrinsic value.
Dr. Cross, you're first. I'll take a shot second.
Very interesting company. I always like how these type of companies bring together different brands and are able to maintain shelf space at pharmaceuticals and retail stores. Management has to be pretty good. In my opinion, this company, a lot of the decision about whether to add it or not is strength of management and their ability to identify good acquisitions and then integrate it into the company. Convince me this is a good management group.
Yeah, absolutely. So the current president and CEO, Ron Lombardi, he's been there since about 2015 as the president and CEO. Before that, he worked as the CFO, so he knows the company really well inside and out. They also onboarded Christine Sacco, which is the current CFO. And before that, she actually has a very diverse background of financial operations and just leadership and management at very different kinds of companies. One was Older Brands, which isn't in the healthcare sector at all. And before that, she was also vice president and treasurer at Alpha Pharma Inc., which is also a healthcare, but different sort of healthcare segment. So I believe that she has a really well-rounded experience that also contributes to the team. And then in addition, there's William Kapoor, which is the senior vice president. He also works with the general counsel. And they ran into some trouble actually in 2019 trying to establish trademarks and stuff like that in Burma. And because of this, they lost some revenue because it's hard to kind of gain patent controls and trademark names in that country just because it's a little bit less centralized and stuff. So he's been really strong in contributing to helping to like iron out all the legalities issues and things like that.
Okay, thank you.
So, yeah, forgive me if you've answered a lot of these online. I didn't get a chance to see. I'm going to spend some time talking about some basics to your DCF just to make sure I can understand some of this upside and feel comfortable with it. Could you help me understand? Debt to equity looks like it's, what, 50-50-ish, a little bit heavier on debt? I don't need an exact number. Does that sound about right?
Yeah, I believe it was 57.
Yeah, like I said, close enough.
Yeah.
And so what's your after-tax cost of debt, your WACC-ish?
I looked at your model before class, it's 3.
It's 3, yeah.
Okay, so we got 3% after tax. What risk-free rate are you using?
I believe about 2.10%.
Okay, and what tax rate are you using?
27%.
All right, so we got about 4.25% times 60. Okay, so then what's your risk premium in the market?
I believe I put 6%.
5.6%? Or would you?
Or 6.
Oh, 6%. Okay, 6 times 8 is 480. So no risk premium for anything, no adjustments for rate hikes or any of that kind of stuff.
Not at the time that I was doing.
Because the thing I'm concerned by when I see it is I see a 6% whack and I see everybody else today pitching 10, 12% whacks, right? They're either going to adjust a step up for Fed rate hikes. Did you look at all into what might be coming in terms of Fed rate hikes?
I did not go that in depth.
So the market's implying 4 to 7, depending on your friendliest source, which is a whole 100 to 200 bips, right? And so if we use a whack like 6, I want to feel real comfortable that they're not going to need to borrow because borrowing costs are likely to soar. I want to feel real comfortable their beta is likely to stay low. And I worry a lot about a company where I see double-digit growth out all the way up to the horizon in the terminal value year, and yet that's seen as a nice, stable, low beta situation of a company that doesn't need any money to grow like that. And so the model on the numbers you gave me holds up. I'm doing some math real quick in my head. What's your long-term growth rate?
I believe 1.75.
Yeah, that all sounds really good, but I have great fears about a company that has this massive margin expansion, right? Typically, companies can't grow the top line, and I'll help illustrate. You've got top line growth as far as I can see running about 10% a year. And yet we have COGS margin expansion. You're able to actually grow your margins at 1.5 to 2% every year. So let me ask you an easy question that I think you'll appreciate. When you graduate, what would you like to make a year?
A good amount.
How much? Pick a number.
125.
Right. You want to make 125, even more. Fine. And now the company you went to work for doubled their revenues next year. You still want 125?
Probably more.
You do, but wait, your model says they can pay you less proportionately. Oh, so you think the people want more? You're up next. And what happens? You think the cost of the things that they're selling if it's an inflationary environment?
The cost of things go up.
Yeah, and so I'm a little worried. I like your assumptions, but and we didn't get a chance to work, so I don't know. But I'm a little concerned and worried. One of the reasons we have such upside, and I'll bet you still have a lot, is because we made some unrealistic expectations for getting to include things like inflation and the Fed funds rate. And so I would like a follow-up with you, if you're okay, to try to come up with what maybe would be a more conservative DCF model so that we can get something that we can all get our heads around. I'll bet you still got 40% upside, but I don't know because I haven't seen it. Is that fair?
Absolutely.
Cool. Thank you. Sorry for the long-winded question. Is there a question hand up or you?
No, I was just saying the
Still want
$1 million.
Oh, yeah, everyone wants $1 million in this room. Yeah. Yes, sir.
You kind of touched on it a little bit, but could you go into depth about their debt, whether they're fixed or floating rates, and what an increase in interest rates would do?
Absolutely. So you're wondering about their debt structure and just how that might be impacted by the moving rates. So as of right now, I know that they have quite a bit of debt, kind of directly correlating with the companies that they work with. And so I believe that the rates, if they do hike, it will impact them, but it will impact them less severely than if they were going through larger means of like venture capitalists or things like that.
Great job here. I actually really like this company. I like how unique it is to the portfolio. My question is about acquisitions. You say in your third driver that they acquired Ternium in July 2021. What other acquisitions are they targeting, if anything, right now? Do they build any of their products out in home? And then how do they finance these acquisitions?
Yeah, absolutely. So you're asking about acquisitions and then what else have they done and then about how they're going to build out further, right? Okay, so as of right now, they did just acquire Ternium, and they acquired that through Acorn because Acorn just sold them their whole consumer healthcare product line. But the one they wanted to focus on most was Ternium. In addition, they also got other brands such as MagOx and then Multibetic and then Diabetic Tussin. And they didn't touch on those as much in the release because they were really excited about Ternium. But beyond that, they also expanded other parts of their brands in 2020 and 2021, which included additional products in like the Summer's Eve category, as well as I believe the Dentec also expanded with some Goodies Hangover was also introduced, and BC Max. And so they're building their brands as well as they just had this acquisition. So I believe moving forward, they're going to wait for a bit to acquire another brand. And then beyond that, I know that they're putting a lot of money into currently the marketing and then the investment of increasing sales on the newly acquired products.
And do you know how they financed this acquisition?
I would have to look back at it, but I believe they used cash on hand at the time.
Just looking at your peers real quick. I just noticed now that you're weighting them global, but like Merck and Company, they seem like a massive, or so much larger than Prestige. What was your reason for adding Merck as a peer?
Absolutely. So I touched on that on D2L a little bit. The reason I use Merck & Co. is because it is a bigger company. It kind of just is more of an anchor, the way I saw it, kind of mimicking the patterns of the indexes. But I did weigh it lower so that it didn't have too much impact because it does have so much higher of a market cap, but I felt like it accurately represented some important movements within the market that needed to be capitalized and focused in on.
Yeah, there you go. Yep.
Nice job, Kendra. Do you know when your ROIC is going to exceed your WACC?
I did not do too much forecasting for that. I would have to get back to you on that.
Sounds good, no worries.
All right, last one, Elise.
Can you just touch on the supply chain? And it looks like you have 120 third-party manufacturers. Did you look into any of these? Did you look into contracts? Just any that would appease that risk with our current supply chain issues.
Yeah, absolutely. So you're wondering about just the impacts of the suppliers on the supply chain and how that might, like, moving forward, affect the health of the company?
Sure.
Okay. Yeah, so the company does a lot of relationship works. So, like, one of their biggest distributors is Walmart, which is about 21% of their gross sales. And then, like I mentioned earlier, about 123 partnerships with suppliers. And a lot of the things that they do, they get very comprehensive services from the suppliers. And so the suppliers take on a lot of the costs that deal with like R&D and dealing with regulations and making sure they fit within that. So if there is any one company that overly impacts the performance of Prestige, it's kind of offset by the fact that they have 122 other partnerships, which kind of helps to mitigate any one impact of a partnership. Does that answer your question?
Yeah, just well diversified.
Yeah.
Yeah.
All right, well, thanks. Nice. All right, and last but not least, Nasser, come on up and walk us through Pablo, right? Is this, I think so, isn't this Pablo? Yep. Oh, you think so? What? It's easy. You got this. Yeah. Here. All right, so same thing. Help us understand how you came upon this. If there's one big question out there that people keep asking you or something you want to address up front, feel free, and then we'll switch over to Q&A.
All right, well, I think first and foremost, I want to address that I will not be making any bold statements such as that we are revolutionizing the world this time. I think you guys remember my first pitch with REGI. But my name is Nasser Hyat-Khan. I'm a junior in AIM at Marquette, and today I'll be pitching PagSeguro. They're a financial technology solutions company with a primary focus on micro merchants and small to medium-sized companies. Some of the solutions include free digital accounts, prepaid cards, loans, insurance, investments, and you can even pay for your phone carrier on there too, which is crazy. The parent company is Universal Online, a data storage and online payment security systems provider. And some of the things at D2L I'd like to address would be cybersecurity. So I looked into it, and they haven't specified that they've had any attacks on them, including with fraudulent activity. But what I did find was that they use an IBM database to monitor all of their transactions, and then they have a 24/7 in-house security software system set up.
Go ahead, take it.
Yeah, great job here. I have two questions. First, about your peers. it seems that Stone and Aiden are driving a lot of your relative valuation. Could you justify your rating and inclusion of them?
That brings me to another point I forgot to bring up too. So, in the
What was the question?
That's a good question. Justify my ratings?
Oh, yeah, so he was asked, you're speaking some notes, that's all I'm saying. If you could summarize the question and then answer it, that would be.
So I was asked to justify my weighting for my peer valuations. That's a good question. I did weight Stone and Aiden less in my EV to EBITDA, and I noticed that it turned out to be a little too low for the industry average. So after adjusting that, that just ended up giving me, I think it was 15, 17% more upside, which with 94%, it's already very high. So I was doing my best to be as conservative as possible.
Your second question? What was it?
Oh, yeah, and then why did you choose to use a trailing 12 months only for price to sales and not for EBITDA?
That's a good question. I'll have to get back to you on that.
Please.
Can you touch on the short seller report that came out in October of 2021?
Absolutely. Where's Brett? I know. Where'd it go? So, the reason that Viceroy came out with that was because they found that there was an FBI raid on this company called PAX Technologies, which they had a base in Florida. And so what happened with, that's a Chinese manufacturer and seller of point of sale systems. And so the FBI ended up investigating Stone and PagSeguro, and that's why they're shorting them. But at the end of the day, it's out of PagSeguro's and Stone's control whether or not Chinese are stealing information from them.
So are they using the PAX Global for their terminals? Like, what's the relation to PAX? Can you kind of describe that?
Yeah, so for a time they used their systems as point of sale devices to sell to micro merchants to bring them onto the digital ecosystem. And since then, I believe that they've decreased their consumption.
So they still use it or they don't at all?
From my understanding, that's lowering.
Lowering? Did you look into further legal action on PAX Global? So the whole premise of it is that they were, let's see, the machines were being used as malware droppers in command and control locations. So they still are associated with this company that's been accused of this. If you look into any legal action, has it been closed? You know, like just.
It's been, from my understanding, it's been closed. All I know is that the Viceroy article and the FBI raid.
So we go to that in your buy sell that goes out.
Yeah, absolutely.
Okay, thank you.
All right, this might be related to the FBI raid, but could you talk about the third risk and why you added a 7.21 risk premium to the WAC?
Yeah, so I thought it was important to note that when translating to the dollar, the company looks weaker than it actually is, and so I thought it was just important to add that on there to make sure that.
So is that your currency risk premium? Is that what you're trying to say?
Yeah.
How did you get the figure 7.21%?
From Domadorian.
Oh, okay.
Yeah.
Professor Walker,
Can you help me understand a little bit more about pricing per transaction? I just reviewing your write-up, and I don't see any noted anywhere, but you do know that unit volume's up 60%, but I see the revenues are up 32%, so implying some there's price degradation, I would assume, the scale. Can you discuss that, where prices have been going? Could you repeat the question? I'm sorry, Mr. You talk about, you have revenue growth of 32%, you also know some volume growth of 60%, meaning that price is down roughly, to say 30%. So is that true, or is there
revenue per transaction? Can you talk about what it might look like and what it might look like in the future?
Oh, yeah, so currently total payments volume is, I think, 163 billion, as of 2020 with the latest financial information, is at 163 billion reales. And with that, as they acquire more customer clients,
That's okay. Well, so we'll get back to what you'll need to do is look at the amount of revenue you just laid out and divide it by how many transactions they have per year, and that'll give you an idea of what their revenues per transaction are. And then Professor Walker's looking to see if you forecast some expansion on that margin or decrease or growth, right? Any of those things, how you built out your revenue model. Is that a fair assumption or translation? So if you could follow up offline, that would be helpful. I lost track. Maddie, yeah, Maddie.
I was going to ask, did you do any sort of like macro research on the Brazilian environment for like small businesses or regulation and protection they might have?
The only thing that I directly looked into was the president and his COVID misinformation that's being spread. As I found out earlier today, I believe it was 85% of information in Brazil is incorrect. Would that be right, Dr. Cross? Questionable. So I think that impacts small businesses in a fashion that has to make them more, curious before moving forward, and they have to be more cautious when setting up business. Maddie, does that answer your question?
Yeah, that opens up a new door. So then could you just kind of like confirm your confidence in the Brazilian economy? I mean, just like that's what Google search shows that GDP estimates are less than 1%. So then, I mean, then if you're saying your company's growing at a 2% terminal growth rate, like things don't really add up there. So could you just like reaffirm why we should be investing in this Brazilian company, given the macro environment?
Given the misinformation and so.
No, given the recessionary macro environment, Brazil's going to most likely enter in the coming weeks.
Could you say that again? I'm sorry.
If Brazil's going to go into a recession in the upcoming weeks, can you justify this type of growth in your projections and those sorts of things? Is that a fair assessment, Maddie?
Yeah.
Well, I guess this brings into question the United States Fed decisions that are upcoming, right? If we increase our interest rates, then what does that do for businesses, right? Then it's going to be harder to take out loans. And I think the same.
Yes, I think the bigger question is, this is a macro kind of play in Brazil. How confident are you of Brazil in terms of its growth over the next 5 years?
In terms of e-commerce, I'm very confident.
I forgot now. I know it's on. There we go.
Quick question. You kind of touched on it earlier. You mentioned your currency risk premium. And then we're just talking about the political instability of Brazil, how Bolsonaro, according to some news reports, moving somewhat towards a dictatorship. I was just wondering if that currency risk premium was the country risk premium, or if that what the country risk premium was.
That was the country risk premium.
So it includes country and currency.
Yeah.
Okay. So my question is, I don't know if you know it, we can follow up on it. I know you were assigned this by someone shortly ago. Did you look at what the transactions per second are for this company relative to the peers? Because if we're going to be in a space where processing time is important, to feed off Professor Walker's, there's 2 points that are really important in the e-commerce industry, right? How much do you make per transaction, but how many of those transactions can you ultimately put through before CapEx has to increase and the transactions go up? So can you talk a little bit about what they're capable of, what it costs to upgrade, and maybe what it looks like compared to their peers?
Right. So I didn't find anything directly like it was for Visa, where or any other large payment processing company, Visa, MasterCard, you name it, where they say our system can hold, say, 67,000 transactions per second. But I did find out how much money runs through their system per second. So in the case of PagSeguro, it's about $1,000, and it's increased on average 45% in the last 3 years. In the case of Stone, they're about $105, and then Cielo and Aiden are.
So believe it or not, you're actually answering Professor Walker's question right now. Yeah, right in front of you, and that's fine. So a thought for the class, we don't have to do this one online. As you get more and more into e-commerce, especially payment processors, even if they don't disclose that number, one way I like to do things is go back and look at what they said they processed before, and then look what their CapEx spend was in their tech. You can approximate how many more transactions they got out of their CapEx spend, and you can make a rough guess then and what it's costing them to upgrade their firms and what that upgrade is getting them. Does that make sense? I don't expect you to know all that, but thanks for sharing. Was there one last one?
Last question. Just to put it in context,
Oh, yeah,
to give you a chance here.
I'll get you one.
because questions have been all over the place. What is the number one thing that you want us to take away from this stock and why we should put it in the portfolio?
Well, I think it's quite apparent that e-commerce is growing in Brazil, whether you can see that or not. And I think that the niche that PagSeguro focuses on, like being micro merchants, it's important to see that those groups in particular take up the largest amount of moving of funds, whether paying for a good or service. And because they target them, that's something that Block and Venmo haven't been able to accomplish. So by taking up that market, they're going to be able to take up more market share in the future.
In the second largest population country in the world. I'll add to that. Okay.
Sure. Right? I think China and India. That's okay. I said China and India had 1 billion people. I don't know. 400 Canada. All right. Thank you very much.
All right, that concludes the first week of presentations. Early in the semester, we look forward to this every week.